Have you decided that the time has come to knock down and rebuild? You could be throwing away money by not doing this before a knockdown and rebuild. Hey everyone, Tuan, founder of Tax Quantity Surveyors, here for another video designed to help you become a better property investor. Many investors have started considering that the knockdown rebuild process may be more practical than owning and buying an investment property. For example, many investors knock down their family home to build a duplex to live on one side and rent out the other. Now, it does cost slightly more to build a duplex than a single freestanding home. It is cheaper than building two single freestanding homes and offers potential of much greater equity and cash flow. If you're considering the knockdown rebuild process, you'll need a cost report. And in this video, I'm going to tell you why, so stick around. Before we get into it, we want to be clear that this video is for informational purposes only. In no way should you interpret this as tax advice. We always recommend working with a qualified accountant or tax agent who can give you the best advice for your situation. Step 1 of the process is the knockdown stage. This involves clearing the land so that it's ready for the rebuild. If you're knocking down a previous investment property, so not the home you previously lived in, then you'll want to consider a scrapping report to claim a tax deduction for the scrap value of the property. To find out how claiming a tax deduction for the scrap value can save you thousands of dollars, check out our video that covers the scrapping reports. With step 2, you'll have to get approval of your development application from the council. After getting a qualified architect to design your new home, you'll have to get an estimated cost plan report. This is a helpful tool to manage costs throughout the project stages. In step 3, you need to get your hands on a section 7.11 council report. This report gives the council an idea of how much the project's costs will be, and it calculates your contribution levy, which is essentially a tax. The levy is calculated based on a percentage of the project's total estimated development costs and covers the cost of the increased pressure on the area's infrastructure. If your development cost estimate is more than the council limit of $500,000, you'll need to submit a detailed cost report to verify the construction cost. Without a quantity surveyor drawing up this report, you may risk paying higher contribution fees to the council than you need to, or even run the risk of undervaluing the costs payable to the council. In some cases, the financial institution or bank where you're getting your construction loan may require a quantity surveyor to prepare an initial cost report to get an idea of the construction cost. This allows the banks to better understand the cost of development, the chances of positive growth, and your ability to repay the loan. Once the knockdown rebuild process is finished, you can move on to step 4 and continue benefiting from a quantity surveyor by getting your hands on the tax depreciation report, which allows you to claim depreciation deductions for Division 40 and 43 assets. You can check out our other videos on Division 40 and Division 43 to see what kind of assets these are. So there you have it. Hopefully now you have a better understanding of why you need a cost report for your next knockdown rebuild. If you're thinking of knocking down your existing property and rebuilding, consider getting in touch with a quantity surveyor like us. We can help prepare all of the reports you need to get the ball rolling. My name's Tuan. I'll see you next time.